The dominant side touching on my stomachs and going right back up. This isn't just happening to me. It happens to everyone. I went through it too. But this isn't because the dominant side is targeting you. If you don't know how the dominant side moves, anyone can get caught the same way. I'm a retail trader just like you. I don't trade on insider information. I've been reading charts and trading on them alone for 14 years. Let me give you an example. In the ocean, there's a whale and there's plankton. The whale doesn't care about plankton. It just swings around looking for its own food. But what happens when plankton stands right in front of the whale's mouth? It gets swallowed whole. The market works the same way. The dominant side doesn't care about you, but we keep standing right in front of its mouth. So it kept asking myself one question: how do I climb onto the whale's back and keep making money? I had to find the dominant side's footprints inside the chart. That's how I spent 14 years staring at charts. And I found one pattern. The days when the dominant side shows specific behavior are fixed. Monday, Tuesday, Wednesday, Thursday, Friday. Each day, their behavior is different. In today's video, I will lay out the entire pattern I found the charts as the dominant side's weekly schedule. The dominant side isn't looking at you. It's looking at money, but most retail traders end up standing on the opposite side. It actually makes sense to think that way. Before they launch, it needs to secure volume. So it either pushes a deeper correction and then goes, gives almost no pullback and just goes, or continues the trend without stopping. These are the only three situations possible. But what if the dominant side repeats similar behavior on specific days and specific times? If you run that pattern, you can ride the winning side. Do you think the chart all moves the same way Monday through Friday? Most traders think the chart moves the same, whether it's Monday or Thursday. So sometimes their strategy works, sometimes it doesn't, and they get stopped out without understanding why. Or they end up holding a losing position for days. Let's think about this for a second. The dominant side is usually described as institutional players. From what's publicly available, these players are known to operate within a reporting structure. They receive budgets, and based on that budget, they push price up, down, or take profit. It's described as a systematic operation. This isn't something one person decides on their own. It's structured at the organization level. If that's the case, it only makes sense that there would be days for building positions, days for launch, and days for cashing out. Mondays are influenced by the previous Friday. It's a scouting page. The dominant side is exploring which direction to take the price this week. If it wants to push Nasdaq higher, it needs volume. Mondays are days it researches. That scouting page shows up on Monday. This is why Mondays have low volatility. Neither side has shown clear dominance yet. Mondays usually chop sideways. Price doesn't trend in one direction. If the previous Friday had a strong one-way trend, Monday might gap in that direction. But usually Monday's gap get filled. Positions from the previous week get closed, and that creates sideways chops on Monday. So even if the chart looks perfect on Monday, price doesn't move much. Dominance hasn't been decided yet. In this kind of range, focus on candle with wicks. When wick candles start appearing during the chop, that means the dominant side is starting to build. Confirm these wicks before entering if you want to succeed with short-term trades. By Monday, last week's positions are mostly closed out. Last week, the dominant side pushed price up from the lows. It finished selling in the second half of the week. The leftover positions get closed on Monday. Starting Tuesday, the dominant side begins build for the next move. These building candles usually have wicks on both sides, because buyers and sellers are clashing at the same time. Tuesdays are when you see the most of these candles. Price then was pushed on Monday, drops all the way back down. Then the buying side overcomes that pressure and shifts its direction. The profit taking from the previous move hits the market Tuesday's money. Then candles with wicks start appearing as the dominant side builds a base. These building candles show you which side is gaining control. And on Wednesdays, the winning side launches in the direction of the weekly candle. The moves at the end of Monday step from your stop loss. Then was the dominant side sweeping the rows, observing volume, creating weak candles, building a base, and then launching a trend in one direction. Wednesdays are when dominance becomes undeniable. Look at the chart from February 25th, Wednesdays. You can see the expansion clearly. One side to full control. Once the dominant side secures the volume, it leads to Tuesdays. Wednesdays are when it fires. This also connects to economic events. CPI and FOMC releases usually fall on Wednesdays. Higher volatility means more volume to absorb. The dominant side builds position before Wednesdays, grabs final volume on the day of data release, and pushes price in its direction. And the move often shapes the weekly candle closing price and higher price. So Wednesday's high is a very high chance of becoming the weekly high. Not 100%, but the tendency is strong. My biggest winning trades this year all came on Wednesdays, every single one. Because that's when dominance is the clearest. Once the dominant side has made its move, what comes next? It needs to collect its cash. Thursday are when retail traders start jumping. They see Wednesday's trend and think it'll keep going. The dominant side uses these pullbacks to sell into retail traders' orders. When retail traders jump in during these pullbacks, it becomes a good window for the dominant side to upload their positions. It uploads the position it built on Tuesdays by filling against the new buyers. Look at this chart from the 26th. Price gaps down and starting sliding. Traders who enter Thursday thinking it's just a pullback start getting trapped. They were standing on the wrong side. I've done this myself, entered Thursdays with full conviction and dragged the loss all the way into the weekend more than once. Had I known the pullback would go deeper, I would have waited for the correction to finish before entering. But I didn't know that, so I kept getting trapped. On Thursday, wait at least 2 hours after the open before trading. The pullback can go deeper than you expect. This applies to range-bound and bearish markets about 70% of the time. In a full bull market, the remaining 30% price keeps gapping up and then pattern changes. Fridays are the wrap-up. When you look at Friday charts, you often see the flow of closing positions before the weekend. So Fridays rarely give a one-way trend. It stays in a range. If the dominant side's profit taking extends, it carries into early next week and affects the Monday gap. If the dominant side pushes the price up and then cashed out, Monday's gap up. If not, Monday's gap down. In a normal week with no special events, Mondays usually gap down. This only changes in a confirmed bull market. The bull market filter is simple. If the daily moving average is right now bullish, it's a bull market. In the case, Fridays produce a move, Mondays gap up. Wednesdays expand. The cycle repeats. In every other market, Mondays typically start with a gap down. In conclusion, it is simple. Focus on Tuesdays and Wednesdays. On Tuesdays, find the rows. On Wednesdays, read the dominance and take profit. Monday, the direction hasn't been decided yet. Unless a clear breakout appears, trade the correction side or close out existing winners. Thursday, expect a pullback deeper than normal. Trade late, not early. Friday, treat it as a range. Now let's go deeper. Within each day, how do you read each session? The Asian session is where the dominant side builds positions. Most traders run that Asian session is a range. That's not wrong, but almost nobody knows why it's a range. When the dominant side needs to collect volume, price can't move much. If it places orders at once, price spikes it. So it quietly observes orders during Asian sessions. That's why it chops sideways. Dominance is being built in silence. This often continues into the London session as well. So how do you spot this building pace? When the dominant side is collecting volume, one pattern always happens. A wick that breaks the row and reverses back up. Look at the last 5 candles, find the row. When a wick breaks that low and price snaps back up, the dominant side is building. When a wick breaks the session row and reverses, it is always a sign of position building. The dominant side triggers the stimulus order sitting below that low, observes the opposite side orders, and pushes price back in its direction. It has no intention of pushing lower, it wicks it and reverses it. That zone is the dominant side's average entry price. Only a large group can move like that. Drawing this demand zone is simple. Connect the wick tip of the candle that broke the row with the wick tip of the next candle. Draw a box. That box is powerful demand zone. Let's look at this chart. Here, a wick breaks the row of the previous 5 candles and reverses back up. The next candle rips the row higher. The buying side is gaining control. Connect the wick tips with a draw box. This zone is where the dominant side triggered stop and collect volume. It acts as a strong demand zone. Look at this one. The previous row gets broken by a wick. Connect it with the next candle's wick. This demand zone formed during the Asian and London session acts powerfully in the moves that follow. Same thing, draw a box between the wick that broke the row and the next candle's wick. You can see multiple bounces from this zone. This zone is the dominant side's average entry. It is easy to identify. The dominant side does not push price far below its own average price. That tendency is very strong. Breakouts usually happen during the New York session. This is usually when the dominants get confirmed. If the dominant side finishes building during Asia and London, if breakout comes in New York. The breakout direction tells you which side won, hence the dominant side. At this time, what you need to identify is where the building pattern ended or where the wick sweep building page stopped. Once building ends, a candle close above or below the range. This is the breakout. This is when dominance was confirmed. Close above the range, buyers won. Close below, sellers won. That direction is where the winning side is heading. If the breakout comes early in New York, volatility is high and risk to reward can be very large. But if you enter before the candle close, you can get trapped at the top. A confirmed candle close is the real signal. When the dominant side closes the candle in its favor, it means that side won the game. And just because the dominant side moved in New York doesn't mean you hold forever. Even while price is rising, profit taking is happening. So when a pullback comes, don't get excited and think it's a dip. Read it as a sign that some positions are being cashed out. But if price keeps pushing with full-bodied candle and no pullback, that means dominance is being maintained. You can consider the holding. By now, the picture should be clear. The Asian session gives you a range. When weak demand zone formed by sweeping the rows, the dominant side building. The London session continued the same pattern. Dominance is still forming, the direction is still unknown. Once the building is done and a breakout comes, right before or during New York session, the winning side launches. That's it. That's the entire game. Now let's look at this chart. Asian session range forms. Wick sweeps the row. Building pattern appears. London session, the pattern continues. New York session, price breaks the upside, buyers take control. The move fires up. What day is this? It is the New York session from Wednesday to Thursday. This day, the dominance become clear. This pattern exists throughout any market, Nasdaq, gold, crypto, Nifty, DAX, and etc. It's the same game throughout. I used to trade it the same way every single day, no matter what day of the week. Enter Mondays because the pattern showed up. Price went nowhere. Enter Thursday with conviction, got full differ. Couldn't sell Friday's weak bounce drag the loss into Mondays. I only understood after I started separating my records by day. My strategy wasn't broke. I was merely trading on days when dominance wasn't showing. If you don't know when and where dominance appears, no matter how many lines you draw on the chart, you will get back everything you made. Like me, try filtering by day, spot the week's demand zones in the Asian and London sessions, and the time you spend painfully holding losing position will shrink. Drop a comment and tell me which day has been your biggest trap. I'll read every single one. Trade every day, journal every day, practice reading the winning side. You will change. Thank you for watching.